Yesterday saw the latest inflation report out of the US, and on face value, a rise in terms of core CPI and flatlining headline CPI at 2.7 doesn't scream rate cuts, but that's exactly what markets have taken from it. So in today's video, myself and Mohanad, we're going to chew through the fat on yesterday's inflation report. What does it mean for markets? What does it mean for the outlook for the Federal Reserve? And why are the BLS talking about potentially moving from a monthly jobs report into a quarterly focus? What does that mean for markets, and what does it mean for the Federal Reserve? Will they become even more lagging? Will too late Powell become too late whoever the next Fed chair will be? So, like I said, yesterday's big numbers were essentially 3.1 or 3.06, as you can see here, for the core CPI number, headline 2.7. Now, one of the reasons why markets have been a bit excited is on some economic calendars, not all, there was an expectation we could see headline CPI up to 2.8. That being said, there was not an expectation that we'd see a move in terms of that core reading up to 3.1. So as you can see here, a gradual increase in terms of annual price pressures. Is that something to be worried about? Is that something that's going to stifle the Fed? Certainly, it doesn't seem to be the case that markets are worrying about that at the moment. What's your sort of key takeaway, Mohanad, in terms of the numbers on face value as we move throughout, big ticket going into sort of more granular detail here?
I believe that markets are overly optimistic about yesterday's inflation report because yes, we can go into the details of the core CPI specifically and see why it's been elevated to 3.1%. But generally, I'm still concerned about the core or the headline inflation, which is still 2.7%. It's still elevated above the Federal Reserve target. It has been going up in May and June, and in July, it's around the same level of 2.7%. So there is no any recent indicators of, let's say, disinflation or continuing disinflation. So that's regarding the headline. And for the core inflation, of course, we have seen an uptick to 3.1%, which is something that's, let's say, underestimated in my opinion. So I think that markets are aggressive at the moment with the rate cut hopes or expectations. And I believe that maybe soon enough we can see this narrative change, either from comments from the Federal Reserve or maybe the next inflation report or further jobs report. I mean, yeah, markets will do whatever it wants to do, but the narrative at the moment regarding the recent inflation report, I can see that this is overly optimistic in my opinion.
Yeah, I mean, it's a really interesting one because, of course, if in an everyday environment, you would say that the Federal Reserve are looking at these numbers and saying, no, it's too high, we're not going to do anything. You are seeing a number of members of the FOMC coming out with relatively dovish statements, like Bowman talking about the potential for 50 basis point cut. Now, Donald Trump is essentially saying that he's going to sue Powell. He doesn't necessarily say it's because they're not cutting rates fast enough, or they said it pretty much at the same time, but he's alluding to this overspend that is the sort of stick with which to beat Powell at the moment. So there's a feeling that anyone that potentially wants to take Powell's job better come out with very dovish statements and better be backing rate cuts for the back end of this year. And of course, the jobs report was one justification for them to be dovish. And this inflation report was either going to push back against that or not, and allow people to remain dovish going forward. Now, crucially, we did see that rise. There's a number of different elements within each inflation report. As you can see here, part of that will be related to sort of services inflation, which has remained elevated. I think part of the story around this report has been energy prices. And we've got another chart for you on that front as well. I think energy has been sort of the one tool, I think, that Donald Trump has used to be able to try and keep down inflation against the backdrop of course, all of the different policies that he's bringing out that everyone has feared could stoke inflation. So with WTI continuing to fall, I guess the question mark is like, can this inflation from energy really just make up for everything else? If we see inflation elsewhere, but the headline CPI falls because you keep driving down energy prices, is that enough? I don't know. I mean, markets seem to think so.
And this is why I'm concerned about the headline inflation, because even though the energy inflation is going down, which should somehow drag the headline inflation, it's still elevated. It's still around the same levels. So we haven't seen any downward moves, although the energy inflation is actually moving down. And this basically gives a hint that, okay, even if the energy inflation is moving down, how about the other constituents of inflation? This is why, you know, even if we didn't look at the core, even the headline inflation is a little bit, you know, concerning for me. And this is why we have this chart of, you know, energy versus the services inflation, which is also still elevated. It's sticky, and I believe this will give the Federal Reserve a lot of headaches in the next reports.
Yeah, I mean, I found this really interesting. So this is a chart of the 12-month change in CPI overlaid against the 12 months change of just the energy component. Note the two axes, right? So some people will probably think this is sacrilegious to have the two axes, but the direction of travel is the same, right? So you can see on the right-hand side, we have much greater swings, and that highlights the volatility within the energy markets, right? Whereas on the left-hand side, we have the sort of normalized CPI levels. The fact of the matter is where energy prices are going at the moment, headline CPI follows. You can see that close correlation. You pretty much can't see the difference between the lines of late. So it really highlights that as long as he can keep pushing energy prices lower, that is essentially doing the job in terms of Donald Trump keeping inflation lower. And part of that essentially is also the idea that tariffs don't lead to a massive spike in inflation. And this does point towards that being the case. This is one of the major concerns that I have been looking at as a potential precursor to a rise in terms of inflation. The ISM manufacturing and services PMI metrics have seen a surge in terms of the prices paid elements. If you push them by 6 months, that lag that you often see that we've mentioned a number of times in the past about businesses essentially stockpiling ahead of the tariffs, and therefore it will take a bit of time for that to be drawn down, and then the prices will feed it through to the economy. It stood to reason there would be a lag, but pretty much now is the time we would expect to see that inflation kicking in. We're not necessarily seeing so that's why markets are getting quite excited. And if you actually drill down into the different regions where we've seen inflation at this report, we actually saw a sort of overtaking, a move out of some of the areas that had stoked concerns last time around, because we'd seen sort of electrical goods, apparel and clothing, trainers, things like that, right? Those are the kind of things that are imported, and therefore tariffs would play a role. That has sort of faded. And in actual fact, some of the different things that have caused inflation this time around are sort of healthcare costs, used cars, which I find is particularly interesting. Look, if you're going to raise the price of a German car, for instance, or a Chinese car, or just buy an old second-hand car, and you don't have to pay the import duties, right? So there's a story of inflation here, but in actual fact, we're not necessarily seeing the inflation that would point towards it being a tariff story. So that's why I think markets have kind of taken this as a positive, because any sort of inflation that arises isn't a problem as long as it's not tariff inflation. And as you see here, we're not yet seeing that sort of major uptick that those ISM surveys would point to. Doesn't mean it's not going to happen. But for now, the justification for the Fed to remain sort of dovish and willing to act definitely appears to be there. Just another thing of note here I wanted to include was the role of shelter. Shelter is around about 30% of inflation, right? And what's interesting here is if you've got that core number, which is 3.1%, which is the concerning part of this inflation report, if you strip out the shelter element, you're at 2.5. That's a much healthier number. Now you might say, well, you can't just strip it out because shelter is there for a reason, and it's heavily weighted for a reason. If you think about your outgoings on a monthly basis, shelter's a large part of that. But as you can see here, it's on a downward trajectory. It's a very slow moving beast. And so you can look forward and say, well, we're sub 4% now, we're going to be sub 3% before long. And this sort of downward trajectory is expected to continue. So I guess for traders, it's always difficult to know. Do you just look at headline numbers, or do you have to sort of geek out and start trying to look at the nuts and the bolts of, like, is it shelter? Is it tariff led? Is it this, that, and the other? I guess from a trader's perspective, when you look at these numbers, do you always just sort of start to react immediately to, like, this is the headline number and that's what markets are going to care about? Or do you think to yourself, I'll trade on this, but I also need to start researching all of the sort of the parts that go into it, because there might be a kickback within the markets where they realize that okay, we have seen inflation, but it's not tariff led, or it could be the opposite. We might see disinflation, but actually underlying inflation pressures coming from the parts that we don't necessarily want to see and could be troublesome for the Fed.
I believe that, yeah, as you said, shelter is one of the things that's really important on a daily or on a monthly budget for anyone. Yes, we can argue that basically shelter prices are lagging a little bit because, more leading indicators when it comes to the housing prices are, let's say, rent and so on. However, this doesn't deny the fact that shelter prices are still elevated at the moment. So if we're discussing right now that the Federal Reserve might cut, 3 times of interest rate cuts during this year, how about the shelter prices? Yeah, it's lagging, but if we saw any upward tick again in the services inflation, or specifically in the shelter in inflation, this will definitely be a problem for the Fed. So yeah, we can of course exclude shelter. We can exclude the volatile items like food and energy that we have also discussed. The energy prices, it's really risky at the moment. However, those things that we are just excluding, they are inflationary pressures at the moment, right? They are inflation. Shelter causes inflation. If we have any upward surge in oil prices, this will definitely affect other constituents of, the CPI, let's say, basket of goods and services. So yeah, we can exclude, but how long and how many items we should exclude to understand that? For me, I basically believe there are still some inflationary pressures in the US economy. That's my point about it.
Definitely. I mean, like, the fact of the matter is that, you can think what you want. You can say, 3.1 core inflation, that's no environment for the Federal Reserve to cut. But markets are feeling very confident of a cut. I mean, I would include the chart to show you exactly what the expectations are for September. There's no point because it's something like 96% expectations according to the CME. So that is nailed on essentially. And we're now seeing talk of, well, Trump putting pressure on Powell to cut before September, and then talk of a potentially 50 basis point cut. So it's almost like we've moved on from the idea of a cut in September. And now we need to look at different areas, whether it's going to be like, we're going to cut early and suddenly that could spark significant sort of dollar devaluation. Or are we going to see oversized moves? Another way of looking at it is looking further out. So I always look at sort of the back end of this year. Where will we be by the end of this year? And you can see right now the base case scenario is that we see 3 rate cuts for the remainder of this year, which is 3 meetings. So a cut every meeting, 75 basis points worth of downside. That is the base case, but it's 55% chance, something like that. So it's still kind of a coin toss between whether we see 2 or 3 cuts for the remainder of this year. In terms of the way that things have moved, this might look a little bit confusing. So I'll just quickly sort of explain it. Essentially, each of these lines is attributed to the percentage chance of something happening, right? Whether it's like one rate cut or 2 or 3, right? And the key point to note here is that you can see on the right-hand side of the chart that we've seen a sharp deterioration in the pricing for 1 rate cut and 2 rate cuts, and a increase in terms of the view that we're going to see 3 rate cuts. So that was the jobs report. You can also see just to the right of it where we've also seen the adjustments where it started to drop off a bit more. That's the inflation report. So you can see that the inflation report, despite that rise in terms of core inflation, has moved things back in the direction of how things had moved following that jobs report. And that is towards the idea that we're going to see 3 rate cuts, away from the idea that we're going to see just 1 or 2. The fact of the matter is there's pressure on the Fed. There's a number of different people within the Fed that are angling for new jobs. The jobs report itself has come out very poor, and therefore it provides them with the basis to ease going forward. So certainly markets are in pretty confident mood, not just for September, but increasingly so beyond that. And this is part of the reason why we saw that massive downward revision in terms of that payrolls report, which leads us onto the topic of Trump's pick for the commissioner at the Bureau of Labor Statistics, calling for the end of the monthly jobs report. And I think this is a really interesting one because as a trader, you're so used to this becoming like it's just like the pillar of every month, right?
Yeah.
It's the one thing that you're looking forward to. You write about it, you create videos about it, talking about, from our perspective, the idea of it going away is sort of a strange one, really.
But just
You
think
know,
of the
what do
volatility
you
that could
think?
happen during the 3 months, release. If this happens, the
Drip feeding us
volatility
data.
during the quarterly report, if it happens, of course, it will be very, very good, even more for traders, right?
I mean, like, it's funny because it highlights the whole conversation of, like, do you like trading around events or do you not? Because certainly when you do, if you're doing a video, maybe you might do a live talking about, like, let's look into the jobs report, and you might do a video before it, and then the report comes out and you look at market price action afterwards, etc. You're
Mhm.
kind of ignoring the fact that some people absolutely hate trading it. It's not a given that everyone likes trading these events. A lot of the time people just like minimize their positions because they don't want to be in around this. So maybe this is great news, right? Maybe this is just less data. Just give that no data to anyone, and therefore you just let
Yeah.
markets just do their thing.
Yeah.
Yeah, I mean, one thing I wanted to sort of note about this, and why I think that this doesn't stand up, so I don't necessarily know this is going to come to fruition, is the fact that if you're talking about Jay Powell being slow to the gun when it comes to cutting interest rates, try giving him less data to make his decisions on. If suddenly he's got to wait another 2 months or something for the next jobs report,
Yeah.
it just gives them less justification to act. It means they're going to be a lot slower, and I don't necessarily think that there's a justification from that perspective
Yeah,
to
I think
taking away data.
it's terrible, having a quarterly report, especially from the labor market data, because if we're going to have 4 jobs report in a whole year, while we have 8 meetings from the FOMC or the Federal Reserve, so every other meeting they will basically be saying, okay, we don't know what recently happened in the labor market or the jobs market, so we don't really know what is the best course of action, especially in a period where the Federal Reserve is just following the wait and see approach. We want to wait and see for the data to come out, show us what the economy has been or how the economy is responding to our recent actions, and then we can take action. But if you even remove the data, how do you expect the Federal Reserve to take any actions at all? This is my personal opinion. And this is why I believe the whole idea of, or the whole debate of whether we could have monthly or quarterly reports doesn't mean if you have bad data, to limit those bad data releases to only 4. It doesn't make sense. It makes sense to focus more and to concentrate on this data and how to take any course of action in order to support the economy. And even more, even if this happened just out of imagination, if we have this quarterly report thing, I don't think that it's really good for the Federal Reserve to rely on private data providers in the US economy, because it should be governmental. And if we are talking about the politicization of the Federal Reserve, whether it's affected by the politics and so on, how about the private government providers, this, or the private data providers?
Yeah.
This would definitely be a lot more complicated scenario to work in.
Yeah, that's the crazy thing, right? So I'm so used to looking on Twitter and everyone just criticizes the ADP, saying how useless it is. ADP might be all you go at, I mean, in the
Exactly.
future, it
Imagine.
might be that, like, everyone just, it's like the monthly jobs report is the ADP number. And in actual
Exactly.
fact, it's funny because recent months have shown weakness in the ADP number that didn't show up in the headline figure. And everyone's using that as a justification to say that the ADP number is useless. But in actual
Mhm.
fact, it showed what the numbers were going to look like once you got the revision. So maybe the ADP number is where it's at down the line. But you're
Mhm.
completely right. When you've got a central bank that is so-called data dependent, if you strip away the data, you won't have much to go on. And certainly if Donald Trump is talking about, you've got to cut rates, and now he's whinging that the jobs report wasn't good. The jobs report is going to be the thing that helps you cut rates. You should be thankful that it's given you this sign, and therefore we're going to see a more dovish stance from the Federal Reserve. Now, I just wanted to wrap it up by noting that the things tie together, right? The weakness of the jobs report ties into the inflation report because it's the BLS that also creates the CPI numbers. Now, notably, we've been seeing, of course, huge cutbacks in terms of spending. You've got Doge and the like trying to cut jobs left, right, and center. And we've seen a similar kind of thing at the Bureau of Labor Statistics. And part of that has meant that, like, some parts of the US that previously were surveyed aren't being surveyed anymore. So the amount of inputs that are going into the US data now on the inflation front is declining. So are we now going to get into a position where they say that number's useless as well? I mean, it's just, where does this stop ultimately? They need to maintain funding. If you want good data, put some more money into the BLS, and they'll be able to give you better numbers. They're withdrawing money and then saying how useless it is, and then saying, maybe we'll just do it once every quarter. So it's going to be a really interesting story for markets, for any trader out there at the moment, really, to gauge exactly what happens in terms of where we go from here, whether the BLS are going to make it less frequent or not, and whether markets feel like they can't really trust the data as it comes out. I mean, I've certainly been around the block enough times to know that there's this criticism levied at the Chinese data to say, oh, you can't trust any of it. Can we trust the US data? Who knows? I mean, I don't think the US even know how to trust the data. In any case, let's jump into the charts and see exactly how things are setting up at the moment. Of course, market's very confident in rate cuts. And so what's the implications for stocks, the dollar, gold? Mohanad, take it away. Let's just get it up and we can have a little look at how things are shaping up at the moment and where we think might go from
Okay,
here.
so basically having a look on the dollar index here, and specifically on the daily time frame, we can see immediately the weakness that we have seen yesterday on the 12th of August after the CPI report, because as we have discussed, markets are expecting now 3 rate cuts by the end of 2025, and whether I personally believe this is something that's going to happen or not, my opinion, as you said, it's useless at the moment, as long as the markets will trade what it sees. So basically, the dollar index, given the current, optimism or expectations of 3 rate cuts, I believe that the dollar index will continue moving lower. And we previously discussed.
Just quickly, what's really interesting about that? If you look at that price action over the course of this month, right? You can see the chart that I showed before in terms of the market expectations, how it collapsed, rebounded a little bit, and now it's dropped back down a little bit. That we saw in terms of market pricing, it's pretty much replicated here for the US dollar. So what you know is that anything that happens that points towards more rate cuts, that's bad for the dollar, right?
Exactly. So that was the collapse with the NFP report, right, on the 1st of August on Friday. And then we tried, to see this, rebound. However, the inflation report came and it just is moving lower. However, what's really concerning to me on the dollar index right now is that, given the whole downward trend that we have seen since the beginning of the year, this was just a retracement here, which is, an ABC correction or a retracement. So the key level for me to watch right now is the levels of 97.15, let's say, because this is the last low that was basically created in this correction. So if by any chance we test, of course, we'll be more probably testing this level, but I mean, if by any chance we close below this level, I believe that the dollar index will just continue on moving lower and lower throughout maybe the next couple of months. But whether we break below this level or not, this is something to be seen. And again, let's not forget about the Jackson Hole and any comments from Jerome Powell, because it's in the market's nature to sometimes get over aggressive with rate cuts or rate hike expectations. However, whether the Federal Reserve and the comments will support this or not is yet to be seen. If we're going to look at the euro, let's say, it's exactly the same on the opposite side, right? So this is a correction of an ABC. We are currently moving higher to test the recent highs here, right? So in case we get a full candle close, a daily candle preferably, above this level of 1.18, let's say, this is the key level to watch for. I believe we will be moving way higher on the euro versus the dollar, not because the euro is getting any stronger. Of course, things in the eurozone are more easier for the ECB. However, this will be supported by the weakness in the dollar index. What is basically left for me to say here on the Dow Jones is we are still trading below the resistance level, 45,000 points, right? The momentum is not really great here, and I'll just wait for the retest, the third retest of the 45,000 levels. So that was the first retest here. That was the second, and we are heading for the third one. So we will probably break higher if markets still believe 3 rate cuts are due this year, breaking above $45,000.
This is the outlier as well, isn't it? Because the Nasdaq and the S&P 500 both hit record highs, with the Dow is the one sort of lagging behind.
Yeah, S&P is not waiting for anything; it's just moving higher, and the Nasdaq are just, it's also creating all-time highs. So let's wait and see if the Dow Jones will follow the Nasdaq and S&P to create an all-time high, or probably the Dow Jones will be the one who's more, let's say, wiser, and will reject the levels of 45,000. In this case, if we see any confirmation from the indices, this means that probably we can see a retracement on the Nasdaq and S&P. However, I would say the final thing or the final decision for the markets, whether they will we will see any reassessment of the situation, will be the Jackson Hole, which is, I think, a week from now or a little bit more than that. So this is the final reassessment for markets, whether to continue in this current direction and narrative, or maybe we can see things shift in the other direction.
Yeah, so Jackson Hole kicks off on Thursday, Friday, Saturday. We'll have to see exactly what's what in terms of the lineup for who's speaking and when they are. We'll make sure we'll provide a video for that as well.
Oh, of course, yeah, definitely something.
And gold.
Yeah, for gold, let me discuss gold as well. Yeah, so we are currently just still trading around the levels of equilibrium that we have discussed previously, let's say around the 3,350, and you can see how much the price action around those levels are just all around the place. I believe, given the current expectations of rate cuts and inflation numbers and everything, I believe that this can act as a short-term support, and maybe you will be moving higher during the course of this week and probably the next one to test the highs around 3,440, 3,440. But again, whether we will break above this or not depends on the narrative when prices are actually trading near those levels. However, of course, aggressive rate cuts on the interest rates is definitely something to boost gold higher, right?
Yeah, it's an interesting one because gold, of course, benefits when you have a sort of looser monetary policy outlook, but at the same time, people utilize it as a haven. So when equity markets are pushing higher and you see additional rate cut hopes, gold can get a little bit confused, and you're seeing this sort of sideways price action. Notable that we're seeing the outperformance in terms of silver, which I think is a really interesting one, where you see the rate cut sort of benefits of the precious metals, but also sort of a pickup in terms of expectations around growth. Of course, it's an industrial metal as well. So silver, I think, is a really interesting one to be watching as well. Anyway, that's all we've got time for today. Thanks a lot for joining us. I hope you've enjoyed it. Make sure to like, subscribe for more content like this. But certainly, like we said, next week, Jackson Hole should give us another key topic to be following. Let's hope they don't sack off the monthly job report. We want more data, not less. Thanks a lot for joining me today, Mohanad, and thanks for you guys as well.
Thank you.